Hey traders, welcome to Charts and Coffee. Hope everyone's having a good CPI morning. We just wrapped up a session in the Sector Secrets Mastery. And in that session, we took advantage of, well, let me show you here. We took advantage of the move higher by shorting into it, taking a quick retracement, and then moving to a break-even stop. The plan is to be out or at least tighten our stop before the bell. So that gives us about 29 minutes before we have to do any of that. But, the plan that I want to guess at which way the data is going to move, let me just touch on this for a moment. Anytime we have a high impact event, it could be an 8:30 economic release, it could be a 10 o'clock economic release, it could be any number of things. Ideally, it's something that has a headline number and then it's done. There might be a little bit more nuance to some of the numbers that are below the headline number. Like, for example, when we get NFP, there's a lot of data in the NFP, even though we have three main headline numbers that we're looking at. But the reaction to the number is, you can guess, you can make a binary guess at whether or not you want to be long or short in front of it. And it could either really be great or it could be an absolute nightmare. Imagine being short, NQ or ES before the CPI this morning. It would be fairly painful. So what I like to do is wait for price action to exhaust in a volatility zone. And that's exactly what we did. We took advantage of the move on the volatility zone and took our positions in that zone, actually at the extreme of that zone, because this morning we really didn't have a lot of clarity in terms of directional bias. That's okay. We modify to say, look, if I'm not super clear about direction, I'll forego an aggro, or I'll forego the aggro and moderate trigger and focus on the conservative. Anyway, that's really it. If we sink a little bit into the bell, fine, but I do not want to be holding this position without a tightened stop to lock in profit, which I'm still in some unrealized profit on half of my position. I don't want to be in a position at 9:30 where I don't have at least some sort of stop order to get out if we happen to shoot back up again. So that brings up the next thing. And it's a question that Captain Jane's asking. It's a great question. Can we expect an echo to the upside? And I would. What does that mean? Well, remember, when we're trading any kind of 8:30 economic event, it's futures really, or Forex only, because those are the markets that are open and liquid and moving and grooving. Right? Remember, the Wall Street bell hasn't rung, and I'm not going to engage pre-market in equities, in stocks or ETFs. So it's a futures contract trade, focusing mainly on the mini or micro NASDAQ and S&P. And so what I want to remember is at 9:30, now I get another wave of participation. Now I get another group of traders that want to now place their bets on what they think this CPI number means to equities. And ultimately what it does mean and where all of this lands. So you'll notice I'm looking at the chart, and then I'm going to head on over here to the Fed Watch tool. This is the CME, Chicago Mercantile Exchange, Fed futures contract that's distilled into these gorgeous, into these gorgeous graphs. It makes it really easy. This is your magic decoder ring to understanding what expectations are around the Federal Reserve's decisions. And you'll notice every single one of these aligns with one of the meetings. All right, that being said, take a look at June. Nothing changed for June. June is a hold. And the question really hasn't been whether or not they're going to cut in June or July. And I would say largely those are both hold months. June to the tune of 91.6%, July to the tune of 65.1%, but September is where it gets interesting. This is a little bit higher a probability at 52.1% than we had yesterday for the rate cut, for a quarter point cut. So what we're looking at is which one of these columns has the highest and represents a rate cut. Now you might say, Rog, how do you know that's the rate cut column? Because if we're currently at 525 to 550, that's this column right here. The lower this column is, and the higher anything to the left of it is, that implies a rate cut at that meeting. So clearly it's not, up near 80%, 90%. aka fully discounted for September. But by the time we get out to November, now cumulatively, there's only a 15.7% chance that we're going to still be at the same rate, and far more likely we're going to be lower. And so that's what, and I know it's May and we're talking about November and September, but this is how the game is played. Traders are looking down the road to what could happen. No different than when in November of last year, we started to see strength in equities and we started to see strength in bond futures, meaning lower yields, because we were looking ahead. In that case, nearly 6 months, more than 6 months, looking ahead to some of the first rate cuts at that point, right, in Q4 of 2023, at looking at maybe a March or May rate cut, which obviously we did not get. But back then, that was the expectation, and the market rallied in anticipation of that. All right. So that's where we sit right now. Nice little trade on that CPI using some futures in the Sector Secrets Mastery room. And then we'll look for an echo probably of even higher highs, because not only was the reaction at 8:30 up, the echo is likely to be up. And it's also going to align with the fact that we're a little bit more, the expectations have ratcheted up just a little bit for the Federal Reserve to cut rates. All right. So that is where we sit right now, 7 minutes past the hour. Let's jump into some questions. Todd, how are you? Good morning. Really appreciate your perspectives. Well, thank you. Look, that's all we can do. Take a look at what we're seeing on the chart. I try not to share my opinion or what I think or what I feel, right? I hopefully am rooting all of this in the data, whether that be my chart or whether that be the way we broke apart the Fed Fund futures. So I appreciate your time. No, absolutely. Thanks for tuning in. All right. Next up is GJ. If I'm looking at the IWM, I'm going to trade the Russell, right? Because the bell has not rung. Yes, there might be some movement. Let's go to the RTY futures. There might be some movement pre-market, but the liquidity and the accessibility, I think, is better at that time of morning, based on volume, based on open interest, based on ease of getting in and out during high volatility times. I would focus on the futures contract. So I don't trade stocks and ETFs or even the options of them pre-market. I would consider that market for me largely closed, right? Just because they're moving doesn't mean there's always going to be liquidity. But in the case of IWM, to your question, why not look at the micro or mini RTY at that point in the morning? You really can't trade them, gang. I mean, they might be moving, right? You can open up your chart and see there's action in certain stocks and ETFs, but you really can't trade them, can you? So that's why I say you can't look, can you trade futures options? Sure. Can you trade stock options and ETF options? No. Are they really moving? Not with liquidity, right? So you really, let's just kind of put them in the category of before 9:30, you really can't trade them. So use the alternative to them, in that case, the RTY. All right. All right. Next up is question about, in terms of day trading indicators, are they still available? Yes, I would recommend. Thank you for the question, my friend. If you are, and I'm going to try to say, Falake? I'm a Raghee, so I totally get the mispronunciation of names. I would use top tier. That is what I'm using now. That is what is most ideally suited for the modern markets we're dealing with, where we have historic retail participation. We have some of the most active algos running that we've ever had. The adaptation from a trader trading 20 years ago to now is pretty massive. And a lot of it has to do with different influences on price action that, frankly, we haven't seen at scale like we do now. And that's why top tier is definitely going to be the best way to do it. So thank you for the question. All right. Next up is, so futures trades only, gang. Yeah, we start off every one of those 8:30 sessions when we do a bonus session in the Sector Secrets Mastery, which, by the way, you can check out at sectorsecrets.com. Every time we do one of those, I remind everybody that the way that we want to do that is through the mini or micro futures, right? Remember, just kind of until 9:30 and at 4 o'clock, I don't look at pre, I don't look at post. 9:30 to 4 is the window for stock ETF and stock and ETF option trading. And I'll look at futures before that, and I'll look at futures after that if there are events that I want to trade. All right, next up is good morning. Good morning. Can we take a look at gold and crude oil? Sure. So remember, anytime we're looking at gold, before I get to GLD or even the miners, GDX, I want to look at GC futures. And that's not because of the time of day alone, but because remember, GLD is going to move largely based on what we see on GC. And unlike GLD, GC is a nearly 24 hour. These things trade about 23 hours a day now. So if I can look at the GC and get a running start, a much more complete look at the price action around gold, that's going to give me an edge in GLD. And, would I look to be a buyer? Frankly, I should have been. One of the things that I was really hesitant about is the fact that when we have Powell, we can see disproportionate moves in gold and in notes and bonds. And frankly, I had a setup on Monday, which I'm going to go back and say, Rag, yellow candle hit the gray zone, and that's the follow through from that point right there. So that's what we're looking at. And that's been the buy, the most recent trade, the buy in gold. I would leave crude alone for now. Crude's quite bearish, whether you're looking at the 1 hour or the daily. Again, I'm going to go longer term timeframes because I won't know what I'm going to do day trading wise until after 9:30, 9:40. But as far as crude goes, ever since really the 1st of May, this has been much more bearish. And again, USO is going to map to that. XLE, XOP, OIH. So not just oil, but oil stocks as well. All right, next up is what is the best? Hey there, Eddie. What is the best volatility indicator I can use to determine the strength of all the indices? I would not do that. Yeah, I would not. So Eddie, I would not do that. And here is why. Do not look at, and I try to take this verbiage out of my jargon, the market. There's actually no such thing as the market. I know we all say it. I still do too. The market. Well, which one? Currencies, treasuries? I know you're talking about indices, but each one of them move for different reasons. And that even, if you drill down to the indices, the 4 main ones, really 3 if you think about it, Dow, Nas, S&P, and I'll add the Russell. They're all weighted differently. Just because a Dow is moving higher doesn't mean the NASDAQ has to participate. They're weighting. The composition of stocks and sectors within all 4 of those indices are different. Not necessarily hugely distinctly so, but they are different. And so I don't want to look at that at all because I want to be able to separate what day might be better for the NASDAQ versus the Dow, or what day might be better for the Russell versus the S&P. Because if you break down what's in them, think of them like cookies, right? A sugar cookie has one recipe, a chocolate chip cookie has another recipe, an oatmeal raisin cookie has another recipe. If you're a crumble fan, there's lots of flavors out there. And the same thing goes with indices. The composition, the recipe for each one of those is different. So I would go and say there is not one, right? And please don't think market internals like put call ratios or tick or whatever is out there, including VIX, is measuring all the indices. They're usually looking at a singular index. So VIX is the SPX option. So it's more S&P, which has nothing to do with the Russell, right? And it's not necessarily how the Dow is going to move on a given day. And if I take a look at something like a put call ratio or a ticks based on NYSE, right? So remember, we don't really want to do that. We want to look at the actual stocks that are heavily weighted and the sectors. That's the best way to do it. All right, what about GE? Long on a pullback. I would like that. I haven't yet seen a candle that is not a candle of unusual size and hitting a buy zone. We're as close to the DPMR and a mean reversion as we've been. I'm probably going to hold out for the mean reversion to my wave, which is the green, yellow, red line on this chart. I'll probably hold out for that for GE, but I do want to get long. I just haven't yet. All right, next up is what platforms can you use my indicators on? I like to use Thinkorswim and TradingView, and Thinkorswim is probably the platform that I would say 80+%, probably close to 90+% of simpler members, all simpler trading members are on. I'd say it's 80 or 90+%. So definitely Thinkorswim. But then I know there are many people who like to use Tasty or Interactive Brokers or any of the other trades, Tradeovate or Tradier. There's a lot of others out there. And that's where a broker agnostic platform like TradingView is really important. Now, I trade off a number of different platforms. I have Thinkorswim running, but I'm a huge fan of TradingView. And so TradingView is the other one that we support. I'm a big fan of both of those. And if you don't use Thinkorswim, yeah, please do consider TradingView. It's great. Again, broker agnostic. All right, next up, now I'm hungry for cookies. when is there not a good time for cookies? I was looking at the Crumble menu this week. I'm going to pass, although the French toast looked pretty good. They had wedding cake. I'm thinking what else was on there that caught my eye. All right. So let's take a look at what we're seeing going into the open, because I want to make sure those of you that took the shorts in ES and NQ with me after that move on the CPI, remember that as we get closer and closer to the bell, we want to go ahead and either exit or put a break-even stop, which we actually already have, or lock in some profit. There's not a lot by way of being able to put in a trailing stop because we'd be so close to current price action. Maybe something just above 52.97 on the ES, and on the NQ, maybe something just above 18,522, meaning that we're short from levels that are higher than that. So if price moves back up, we can at least lock in some profit. And if price wants to just move down from here, I've given it a little bit of a cushion, so I'm not smothering the open trade and the unrealized profit, but I'm not going back to my break even. So that's something that we'll discuss when we move back into the Sector Secrets Mastery Room. And again, if you've never checked out what we do in Sector Secrets and you're really maybe learning for the first time today, oh, wait a minute, Ron, you trade futures in there? Yeah, we trade futures in there. We trade stocks, options on ETFs and stocks. We trade futures. And the idea is if you are measuring any market as best you can with 4 factors: price, volume, volatility, and time, if your indicators are aligned to that, there's nothing you really can't trade, because those are the influences on anything: stocks, futures, ETFs, Forex, right? Time, price, volatility, volume. Those are always going to be where a lot of our setups are going to be rooted in. And since we're using those factors and not focusing on how do I trade the NQ, right? We're focusing on the psychology of any market. As long as your indicators are measuring the psychology of a market, as long as it's a liquid market, there's not a whole heck of a lot that you can't trade. And that's why we are able to do as much as we do. And then add to that automation, right? We automate the analysis. So I have a volume tool. I have a volatility tool. We have different tools to measure the structure of the market, and they're either automatically drawn lines or they're color coded. And with that speed, we can get through more of the market and find opportunity. And that's really it. Okay, gang, as always, thank you so much for being here for Charts and Coffee. We've been doing this show now for over 3 years, and I thank you all for tuning in. You're the reason we're here doing it. And we'll be back tomorrow. Heads up for maybe that echo in the CPI reaction as Wall Street opens. And remember that we're a little bit more favoring those rate cuts, even as soon as September, on those Fed fund futures, and equity should like that. All right. Onward and upward, gang. I'll see you tomorrow. Same time, same station.